Just give it a few more moments and then we can get started here. We got some folks that are just connecting in. I want to make sure that they can hear us when we kick things off. I think you could get started here.
Perfect. Good afternoon, everyone, and thank you for joining us for our quarterly market commentary. I'm Jill Sherman, advisor and director of wealth management here at Forefront Wealth Management. I am delighted to be with all of you on screen today, and I'll be kicking things off in place of Adam Kozowski, who is unable to join us. As Director of Wealth Management, I work closely with our advisory team to support your financial planning needs and ensure we're staying aligned with your goals, especially in today's dynamic market environment. We're excited to bring you today's update. Tom Duffy from Clark will walk us through the current market landscape, share insights on what we're watching closely, and answer a few questions along the way. With that, let's get started. And Tom, I'll hand it over to you.
Thank you, Jill, and good afternoon, everybody. Thank you for taking some time out of your day to be with us. So a lot has happened, in the news and the markets over the course of the last several weeks. So today, we're going to talk a lot about tariffs and what does that mean? Will we have a recession? Will we have inflation? How will the market react to all of this? And we'll give you our best thinking on what's happening right now. I do have a little bit shorter presentation today, so I'm gonna share. So let me bring that up and let's get started. So our first slide that I'm going to show you here is what we have described as tariff roulette. And this is, we don't know where that ball is going to land, what countries, what percentages, and it changes, seemingly almost every single day. So that's really why we're in the kind of situation we're in right now with the markets, the way they have reacted, in April. It's, the uncertainty around when that poster board came out, during the press conference in the Rose Garden. There was a lot of countries on there that we weren't previously talking about putting tariffs on, and there were some really high percentages as well. Since that time, though, we have hit the pause button, for 90 days, and we got one deal today with the UK, which the market likes, and the administration is talking about more deals to come, and they're going over to China to talk with them as well. So hopefully cooler heads will prevail here, and we'll get, some deals worked out, and, we won't get the poster board, implemented here. And I think the market, will like that. So looking at tariffs, and, if we were to levy the tariffs that were illustrated there, which they're really targeted towards our top 6 trading partners. So that would be the EU, European Union, Mexico, China, Canada, Japan, and South Korea. So that would account for about 70% of the potential $846 billion in revenue coming from these tariffs. And the other 94 countries, that would be about 30% of that total. So what's the impact of tariffs? Well, that really depends on what countries, what goods are included, what's not included, what the percentages are. So the more tariffs, the higher they are, the more countries, that's got some negative potential ramifications for inflation and the economy. If we're really only talking about China, at the end of the day, and maybe a few other, countries, then, not as impactful on those sorts of things. So, again, time will tell ultimately what gets implemented, but at least we have some encouraging developments, in the last, week or so with some deals, more deals in the work as well. Kind of looking at consumers. So consumers really don't feel very good right now. I mean, we look at some of the consumer confidence and some of the consumer sentiment surveys, and when you start asking people, hey, how do you think things are going right now, with the economy and with the markets and, with all those sort of things, and they're saying, they're not going very well, and I don't really feel very good about what's happening. But if we look at well, what are people actually doing? Are they spending? And they are spending. So we've seen, an uptick, particularly in consumer goods. Now, shoppers are smart, they're savvy, they knew the tariffs were coming, and they're buying things in the first quarter. I mean, they're buying cars and they're buying, appliances and furniture and electronics and anything that can have a tariff placed on it, they're buying it now. So we're seeing a little bit of skewing in some of these numbers, big uptick, big spike in some of these things, because of consumers who are trying to get out in front, of these tariffs. We look at, the markets, kind of the health of the bond market. One way to do that is to be looking at high yield credit spreads. So I don't want to get too technical, here on this call, but just, using real simple math. We like to look at the difference between something that has some risk to it, like a below investment grade bond. Those might be yielding about 7%. And if we look at, well, what is a safe bond, trading at, like a treasury bond? Well, that's trading at, let's say, 4% yield. So then we have a 3% spread. Now that's shown down here. 3% is down here. So 3% or below 3%, that's certainly saying there's really nothing to worry about in terms of the bond market's, interpretation of what's happening. But what happens though, when the market starts to sell off, you start to see that 7 go to 8, goes to 9, goes to 10. And then on the other side of it, the treasury yield could go lower because people are buying those treasury bonds and sending those yields lower. So then, maybe you get a 7% credit spread. So this is kind of how we think about, should we be taking risk? Should we not be taking risk in some of our models? So what we did see, in April is widening of those credit spreads. Now that did get us to get into treasury bonds and cash in some of our portfolios, during parts of April. But towards the end of April and now we're seeing those spreads are moving tighter again. They're not back to like pre-tariff levels, but they've moved back in enough for us at this point to go back to a risk on position. So again, some of the portfolios are now back in stocks, are back in high yield bonds, and we'll continue to watch these credit spreads to tell us and let us know, what next move we should be making here. Lots of volatility, in the bond market. We did see treasury bonds, since March 1st through the end of April, we're positive 1.32%. That's your flight to safety. That's your flight to quality trade. And then those high yield bonds were down about 0.75%, but you could see that they were down a lot more, by April 7th, but they have started to recover from those lower levels. So this is kind of your peak spread between those two yields. That's when we de-risk, and then we go risk on again, as we start to see those spreads tighten again. Bonds also have exhibited a little bit more volatility. We always think about the stock market is volatile. Bond market can be volatile too in some instances. So when we're looking at early April, this is a bond market volatility index called the MOVE index, which stands for Market Option Volatility Estimate. So we did see a rise in bond market volatility. Yields were going up, then they were going down, then they're going back up again, kind of trading all over the place. But they have since started to come back in. That volatility has dampened. And we expect a smoother ride for the bond market, not as much, fluctuations in prices and yields. So bonds are doing what they're supposed to be doing. They're positive when stocks are negative, and they're just generating a consistent level of income, right now, and providing some stability to portfolios. A lot has been made about, well, what was really going on in the treasury bond market in early April? Why did the yields initially go down, but then all of a sudden they reversed and they went higher, even though stocks were continuing to sell off? And there were some theories out there that, well, maybe it was China or maybe it was Japan just dumping treasuries to make our yields go up and, put us into a recession or something of that nature, as a form of retaliation with the tariffs. And we really haven't seen a lot of evidence of that in terms of the numbers, the redemptions, and where they're coming from. And if we look at this chart, just kind of over the last several years, the amount of US Treasuries that China owns has been decreasing. So they're less of an influence on our bond market than they have been in the past. They're the blue line down here. And Japan also has seen a reduction in their treasury holdings as well. And then other countries, the UK, this is very timely. We just did a deal with them. So we don't think they're going to be trying to mess with the treasury market. And they've actually seen an increase in ownership of treasuries. And not shown on this chart are individuals in the United States that own more and more and more treasuries. So we've seen, it's become much easier for the average person to buy treasury bonds. You can do it online. They got a website at the U.S. government that you can do that. So we've seen people that are buying treasury bonds directly, and that's increasing individual ownership of treasuries. And we think the individuals that buy treasuries don't trade them. They buy them and hold them to maturity. So, if we have more individuals owning treasuries that buy and holds maturity, we would expect less, volatility, because of not seeing them sell, before the maturities are up. Market scorecard for April. If I was to do a survey right now and ask everybody, how much do you think the S&P 500 was down during the month of April? You might say it was down 10% or 15 or 20%. Well, it was at one point, but by the end of the month, it wasn't really down very much at all. That was down 0.68%. So all of the volatility, all of the stuff that happened by the end of the month pretty much didn't go anywhere. It was a roller coaster ride in the middle, but by the end of the month, it was fine. We actually saw large cap growth was positive. So these are your big, tech companies. And international was also positive. Even with all the tariffs and everything else that's going on, international stocks, rallied, and bonds, investment grade bonds did well. And the rest of the bond market, not as good. High yield down a little bit, municipals down more. But if you're diversified and you have both US, large and small, and growth and value, and you got some international and you have some bonds, you're holding up pretty well in this sort of environment. And we continue to preach diversification, and I know Jill and Adam work with you all, and that's their philosophy as well. So they don't want to put everything into 7 stocks and just ride the lightning. They want to make sure that you all have the appropriate mix, the proper asset allocation, the right pieces, together for your risk tolerance, your time horizon, your comfort level. And it's this diversification that it pays off. In the market environment that we're in right now, this is the time that the diversification is meant for, and that's helping folks, get through this with really not seeing big losses in their portfolios. Looking at where we are relative, not to the beginning of the year, not year to date, but where are we from the all-time high? So the last all-time high we saw in the market was on February 19th. So international stocks are up more than when they where they were at on February 19th. Now the rest of the market down still. So we still have large value, large growth, S&P 500, and small caps are still down. Now this chart I'm showing on the screen is as of April 28th. A lot of these have gone up, so they're not down too much. They're getting close in some cases back to almost record levels, which seems hard to believe that we could be looking at that at some point. If the market rally continues, we could be looking at fresh highs at some point, later this year. Well, again, time will tell on that. We're not out of the woods yet. We'll see what happens. Now, looking at what we call the fear index, the fear gauge, or the volatility index, the VIX. And this is a really good indicator of identifying market bottoms. It's not so as useful in trying to identify a market top, but it's pretty good in identifying those capitulation moments, so throw in the towel, that kind of environment. So the first one I want to show you on here, it's actually even higher to illustrate it here, but we did get up to 80 on this volatility index when the stock market went down by 50% during the financial crisis in 2008 and 2009. And then we had another big drop in the market in March of 2020, where the market went down by nearly 40%, and the VIX got to 83. So now this latest episode, I call it the tariff tantrum in April. We had the market down by about 20%, and the VIX got up to 60. Okay, which is one of the highest readings that we've seen. It's not as high as the financial crisis or COVID, but it's pretty high. So a lot of the pieces of the puzzle, the stars are starting to align. A lot of the ingredients, that we look for when we try to say that was the bottom, we're starting to see that. We're not calling the bottom today on this call because we're not going to know that until we have new highs, and then we come back. We're going to go back and look at this and say yes, that was it. But we're moving higher. And the higher we go, the more likely the lows were put into place in early April. This one, what Warren says. This is Warren Buffett. We're talking about here, and his expression is to be fearful when others are greedy, and to be greedy when others are fearful. That's a really eloquent way of saying buy low and sell high. And it's worked for him, and it's worked quite well for him. So when we look at some of these surveys, this is a Ned Davis Research crowd sentiment poll. So this is kind of like your retail, mom and pop sort of investor. And where were they at? Well, they were at extreme pessimism in the month of April. And then this other one, the Ned Davis Trading Sentiment Composite. This is a little bit more sophisticated investors, but even they at one point had extreme pessimism. But by the end of the month, they kind of got back to like almost like a neutral-ish kind of view, on the market. And then on my next slide on this one, we could kind of look at, well, since 1995, if you have both of those indicators in optimism, that's actually not a good thing. That's when the market has negative returns in this case, or lower returns than that. So if you have both in pessimism, that's the best case scenario, where the market goes up the most a year later. So we had one neutral, one pessimistic. That's pretty good too. Now we're not guaranteeing it, where is the market going to be in 12 months, but a lot of the indicators that we look at suggest it will be higher a year from now. And one of those other indicators that we look at is this survey from the American Association of Individual Investors, and they have a weekly survey. It's been around since 1987, so there's a lot of data on it. And the question is, how do members feel? Where do they feel the market will be in the next 6 months? Now, when the market's down a lot, 10, 20, 30% or more, usually near the bottom is when you have the highest level of bearishness and the lowest level of bullishness. And that's kind of what we're looking at right now on this survey. So the week ended April 2nd, we had 61.9% bearish investors. That's the highest level of bearishness ever, since 1987. And we're right now, we're on a 12-week stretch where we've had bearishness be above 50%. So we've never seen that before. So we got a lot of really negative investors out there. And we think that's a good thing, because eventually there's not going to be anybody left to sell. They're going to get out and they're going to be gone. And then everybody's going to, look at that and say, well, no one's selling anymore. Well, let's go start buying again and, send the market back up. So these are some fun facts now about the survey in the past. So we'll go back to December 31st of 1999. And there were 60% bullish investors in this survey at the height of the dot-com bubble. Now, there's a lot of people on this call right now. This call is being recorded, but I'm going to admit to all of you right now that I was part of the 60% back in that time period. And I should have been part of the 15% that was selling and getting out. But I just started investing and I didn't know any better. And I thought all you had to do was put a .com after your name and get a sock puppet and go out, get a commercial on the Super Bowl, and your stock's going to go up. And just, you could buy a different stock every week and, it would go up. and that worked for a while until it didn't work anymore. So then I find myself, I got to get a real job in this industry and kind of figure out what I'm doing if I want to be in this industry for the long haul. And I did, and I am. So I go to financial crisis, 2009. Now I have 10 years in the industry, and now I know better. Now I know you do the opposite of what everybody else is doing. And I was part of the 18.9% that viewed the sell-off during the financial crisis as a buying opportunity, when you had 70% that thought it was going to get worse in March of 2009, right at the bottom. And then we can go to March of 2020. Now I'm at Clark Capital, and I was part of the 32.9% that viewed the sell-off during COVID, again, bullish as a buying opportunity. And I don't think there's any question today where I was in April, in terms of the sentiment surveys and how, I was viewing that as well. So I've learned over time, kind of go against the herd, against, how everyone else is kind of, looking at the market right now. We got some important dates coming up for some data releases. A couple of these we've already seen. The first one is the jobs report on that was May 2nd. That actually came in a little bit better than expected. And the unemployment rate is sticking around 4.2%. Then we had the FOMC meeting, that was yesterday, and the Federal Reserve did not change interest rates as expected, but they also signaled that they could do maybe a few rate cuts later this year. The reason they can't cut rates right now is because of the tariffs. There is uncertainty around percentages, which countries, how long are they going to be in effect for, and they have some potential inflationary implications. So until we get more clarity around the tariffs, the Fed is likely not going to do anything. However, if we do start to see some weakening of the economy and the jobs market, then they're prepared to react to that and lower interest rates for that reason. On May 13th, we're going to get the Consumer Price Index, an important report on inflation. On May 15th, we're going to get Producer Price Index, another important report on inflation. And the most important report on inflation will be Core PCE, which will come in on May 30th. That takes out food and energy, and that's what the Fed looks at when they evaluate inflation. And then finally, we will get another jobs report, the JOLTS report. We'll get that on June 3rd. Now, the JOLTS report shows how many job openings there are. There's over 7 million job openings right now. And it also shows number of layoffs, and which is very low, right now. So we're not seeing a lot of layoffs. We are seeing less job openings. We are seeing less hiring right now. Given the uncertainty around tariffs, a lot of companies are pulling back on their hiring plans right now and their expansion plans. So we might continue to see less job openings, but we don't expect that businesses are going to be letting workers go because of tariffs that may not even be implemented. So we don't think, they're going to say, okay, we have to let half of you go because there might be tariffs. And then when there aren't tariffs, oh, wait a minute, we got to hire everybody back. And they're not going to be able to do that. They tried doing that during the pandemic, and they had a very hard time getting people back, in there and getting reopened again. And they ended up having to get new people and pay them a whole lot more than the people that they let go. So I think employers learned their lesson to hold on to your employees as long as possible, but we might see a pullback in hiring because of the uncertainty, around the potential tariffs. So before I kick this back to Jill to start building some questions, I must show my disclosures and my benchmark descriptions. I'm going to put that up there because we're recording this, so let everybody get an opportunity to screenshot it if you would like to, and that's it. So I'm going to stop sharing my screen, and if you have a question at this time, you may type it into the Q&A or chat, or you can send it directly to Jill.
So while we're waiting, there are 3 buzzwords that are constantly talked about all over the favorite news channels.
Yeah.
And our clients know exactly what we say about that. And I know you and Glenn all say the same thing, that to turn off the TV, but there's uncertainty, which you said a million times in our call today. We didn't talk about recession because that's talked about quite a bit. and then stagflation. So, and
Yeah.
that was up quite a bit yesterday
Yeah.
from Powell. So for those of you who are maybe too embarrassed to say, Tom, explain stagflation. What does that mean? And should we be concerned?
Yeah, so stagflation is kind of like worst case scenario, in terms of like the Fed to deal with that. Because it means that the economy is not growing, or it's actually contracting, or it's in a recession. And then you have high inflation on top of that. So on one hand, they would want to cut interest rates to get the economy out of a recession, or growing again. But on the other hand, they can't cut rates when we have inflation, because it will make inflation worse. So the Fed ends up in a real predicament, a real dilemma when they're in a stagflationary environment. And classic one would be in the 1970s. Now, we don't think we're in that kind of environment right now. We have low unemployment. I know the GDP first quarter number was negative 0.3%, but it was negative because of the huge amount of imports that are coming into the country ahead of the tariffs. And then second quarter GDP is estimated to be about 2.2% right now. That number can change, by the end of the quarter. And we're really not seeing in signs of inflation. Inflation has been decreasing. We're running less than 3% inflation right now. But the risk is the poster board. I mean, if the poster board goes into effect, then that's why the market is thinking it could hurt the economy, it could cause inflation, and that's your stagflation environment. And the Federal Reserve they didn't say the word stagflation yesterday, but they did suggest that they could see slowing of the economy coupled with weakening of the labor market as a potential outcome of tariffs. But I don't think that any president wants a recession, a bear market, inflation, on their watch, particularly going into a midterm election year next year, when you have a razor thin margin right now of control of Congress. So we don't think we're going to be put into that sort of predicament. But certainly the risk of a recession is higher than where it was at the beginning of the year, but that's not our base case. We still think that we could avoid a recession, again, provided that we're talking about manageable tariffs. We're going to have tariffs. We're not going to have zero tariffs. We're going to have tariffs. We've had tariffs since George Washington's days. We're going to have tariffs, but if it's manageable, whereas China, predominantly, will be fine with it. But if it's the other 100 countries around the world, that's a different story. But we're already seeing there's two responses to all this. There's to escalate, which China has chosen to do, and then there's to negotiate, which the UK decided to do. So we think there's going to be a lot more countries that are going to negotiate than to escalate at the end of the day. So that would cover stagflation, recession. What was the first one?
No, it was really recession and the word uncertainty. We know why the uncertainty is happening. I mean, it's a word we're all using. But when I go back to the news channels and what our clients talk to us about, it almost is starting to feel, and listen, we're only at May 8th, but it's starting to feel again like it was 2022, the biggest talked about recession that never happened. And we're only at May 8th, but I feel like this is like a repeat of a couple of years ago.
Yeah, it is. And we have a slide in one of our presentations that has all the headlines from 2018 and 2019. So we went into Google, and Google, you could set the date of the search for news articles, and we put in Trump tariffs. And then we came up with all these headlines. We're going to be in a depression. We're going to have a stock market crash. We're going to have soaring prices. We're going to have, all this bad stuff is going to happen because of the tariffs. And none of it happened. And we see exactly the same headlines. Now, look, I know what you're saying and what you're thinking right now. Well, this is a little bit different because we didn't have a poster board, under Trump 1.0 with 100 countries on it. It really was just China. But yeah, I kind of look at that poster board like a prop. It's like, it's scary. It's, it's got all these numbers on it, and it's really done to get the countries to get to the table, like the UK did, cut a deal, and then we scratch you off. We crossed off the poster board. So hopefully we can get more deals, get more countries off the poster board, and then we're kind of just left with China at the end of the day, which is what we think this is all about anyway. But yeah, Jill, like the market hates uncertainty because you could deal with bad news, but you can't deal with no news and just being in this kind of vacuum right now. But we think the tone has softened. Deals are being made, and hopefully cooler heads are prevailing. And we're a little bit more optimistic now than maybe we were about a month ago. And the market has started to turn higher, but we don't want to be Pollyannish about this and not recognize that there are risks. And we're not out of the woods, yet. And the market had a nice run, nice recovery, and we could see a pullback again from here.
Absolutely. And part of it is to the point what you just talked about. There's a 90-day window. Markets have calmed down a little bit because there are countries coming, or we're hearing they're coming to the table. And we'll see after the 90 days are up. If too many didn't come or enough didn't come, there may be that issue where we'll start to see the negativity in the market. Because again, the market's just like, listen, give us the plan. Either we're doing this, we're not doing this, and they'll make their decisions. But the back and forth every other day, that's what's creating that uncertainty that we're seeing, that we experience. And right now we're in a holding pattern, and investors are okay right now, and the market's stable right now, and we're going to see what happens. The biggest thing that Adam and I always talk about is making sure the plan is in place and our clients have active management underneath of their hood of their investments, and that's key in any kind of volatile market. So one of the other questions that's come up previously has been about gold. So you and I were talking a little bit about it before. So no, I'm not going to my local Target with a chunk of gold to pay for things, but what are your thoughts, or what are Clark's thoughts on gold?
Yeah, so we've said over the last several years, we've been getting gold questions. Like, I've worked here for 6 years. I've been getting questions about gold for 6 years. This is now we're getting a lot more questions about it, but we're getting, we've been getting questions about it. And the way that I would have said in the past, I mean, some gold makes sense, right? It's an alternative asset. It tends to be non-correlating, but it really should be a smaller percentage of your overall portfolio and your overall wealth. And there's different ways of going about investing in it. So you can buy physical gold, which we don't recommend because it's not as liquid. There's dealers with markups, and then you have to store it in a safe or a safety deposit box somewhere. So there's expenses of that. And then when you go to sell it back to the dealer, there's going to be a markdown, on it. So how we would recommend investing in gold, and how we do in some of our strategies, like our alternative investment strategies, we buy an ETF. That's a ticker symbol, trades every day that the market's open. We can buy and sell, with no commission, basically, on the trades. So that's how we would suggest going about doing it. What I would say about gold right now is it's had an epic run. It appears to be a very crowded trade. Like, everybody's on this trade and everybody's talking about this trade. And that typically is a time to get out, and or not invest in it. And you can see that on a day like today, when the market is higher, gold's selling off, because that's where the money came out of. It came out of stocks, came out of these, crypto, it came out of bonds, it came out of these things to go into gold. But when these other things start going higher, the people that put their money in gold to get out of stocks are going to sell the gold and go back to stocks. So, we're seeing this breakdown now in correlation, where now gold is negatively correlated to the stock market. So if the stock market continues to rise, you might see gold, sell off here. So I don't know that today is the day to run out and do a big allocation into gold. If you're already in it, maybe think about trimming it. But I don't think today is the day to be adding to it.
Understood. What about, where's Clark's position on, and we watched obviously closely a lot of our different portfolio managers, the risk on versus risk off.
Yeah.
Where's Clark's position right now? Are they more risk on, more risk off?
We are risk on, in 2 of our models, Global Tactical, which is a stock-based model, and then Fixed Income Total Return, which is a bond, model. So we've, I think about 2 weeks ago, we did the initial 50%, risk on again. And then, I think it was Monday of this week, we went 100% risk on again. And I brought up that slide, about the credit spreads and explained that. So we did see credit spread widening. That got us out. Now we're seeing it narrowing again. That got us back in. That's like, that chart is the canary in the coal mine. Like the bond market is smarter than the stock market. The bond market has, anticipated, has predicted some of these things early warning signs. And it takes the stock market a little bit longer to figure things out. So our models are based on what's happening in the credit market, the bond market, and that drives our decisions on, risk on or risk off. So, we are solidly in a risk on environment right now, but we know one tweet can change things. So that's always out there. That's actually a risk to our model, that it can move so quickly that we can't, react to it in a timely enough fashion. So hopefully, we're not going to be getting the tweet in the middle of the day that makes the market go up or down by 10%, in 15 minutes. We don't see that again.
Listen, I know you're teasing about it, but we saw it happen, and and it wasn't even factual. It's like, nope, just kidding, or whatever the response was that one particular day. The markets were down significantly, and as soon as the White House came back and said no, it was back up again, which, again, that's what our job is. That's what Clark's job is. We have to make sure that we're looking at the factual and the actual data, and not taking a tweet.
Yeah, it's actually funny because I was doing one of these calls on that day, and my call was from noon to 1. And, I kept saying the worst thing you can do right now is sell, because it's probably too late. Maybe it gets a little bit, worse, but I literally said this. I said, we could be one tweet away from a pause or a deal or something that's going to send this market up so fast, your head's going to spin and you're not going to be able to react to it. And then you're going to be frustrated, and then you're never going to go back into the market. And we ended that call at 1 o'clock. And I think by 1:30, that tweet actually came out. And I guess I look pretty smart, on that call, at least, with making that kind of statement. But it is true. Like we were saying, we are like literally one good news item away from the market to go up significantly. So you got to ride this out. The worst thing you can do is lock in a down 20%, return in the S&P 500, because we might be positive year to date very soon in the market if it continues to go higher. So we've just made a big recovery. So the people that just stayed the course, didn't panic, stayed with the process, stayed with the program, they're fine right now. The ones that just, threw in the towel and got out, they're now watching this with what we call FOMO, fear of missing out. And either they're not going to get back in, or they're going to chase this thing when it's at new record highs and be buying, opposite. They sold low and they're going to buy high. That's not, we don't recommend you do that. That's not good, sound investment strategy.
So I'm not seeing any other questions, but I'll throw the last thing out at you. Okay. What is Clark's prediction for markets for the end of the year? Are we thinking positive? What are the numbers?
Yeah, we see a better second half of the year. Now everything I'm going to say is the poster board goes away, right? So we don't get those tariffs. But this is what we think plays out. We think what's being done right now is unpopular. Okay, it's causing market volatility. It's lowering, approval ratings for the president and for the Republican Party. So it's not great, but it's being done early in days in the administration. And any president would do this. If they're doing something unpopular, they're going to do it up front. But at some point, we think the narrative shifts over to lowering taxes, deregulation, investing in AI, data centers, energy infrastructure, investing in semiconductor foundries and manufacturing, investing in manufacturing of automobiles and everything else, and that kind of second half of the year, and then kind of that's riding that momentum into next year, into midterms. The other thing that's being set up right now is that these companies are cutting their guidance. They're lowering their estimates. They're saying, we don't know what our earnings are going to be. We're going to be very cautious because of the potential tariffs. But what if we don't get the tariffs? Now these same companies are going to like, well, we have record earnings. We just beat, our estimates. We're raising guidance, right? So all of this could really be a nice setup for the second half of this year. And we have a 6,700 price target on the S&P 500. We're not backing away from it. We're keeping it. We will reevaluate that mid-year, but we might make an adjustment to it. But right now we're sticking with it, which would mean there'd be some meaningful upside. We're basically at 5,700, so we do see some upside between now and the end of the year. It's not going to be straight up every single day, but as long as we don't get those extreme tariffs on 100 countries, we think that the market could do just fine.
Perfect. Thank you. Thank you all for joining us today. We hope you found the insights shared helpful as you continue navigating the markets and planning for the future. As always, if today's commentary sparked any questions, or if you'd like to discuss how this affects your personal strategy, don't hesitate to reach out to your advisor. We're here to help. We appreciate your continued trust, and we look forward to connecting with you again at our next quarterly update. Until then, take care, be well, and thanks again for coming to our meeting. Thanks, Tom.
You're welcome. Thank you, everybody.